David, tell us about Raymond James and the kind of deals that you work on there.
So Raymond James was founded back in the early 60s. It's a public company, went public in 83. It's now close to a $10 billion in revenue company, probably most well known for its wealth management business. But the investment banking part of the business has actually been the fastest growing over the last 5 years. From a kind of transaction perspective, M&A is what we do a lot of. And over the last 2 years, each of the last 2 years, we've closed over 220 M&A transactions. And of those, close to 160 of those transactions each year involve private equity firms.
David, how have higher interest rates and now the prospect of a recession impacted the sponsor deals that you're seeing this year?
And I think the recession is really causing buyers to really try to understand what is the sustainable level of the business going forward. As a result, buyers are being very cautious about what they're valuing businesses off of, and are more concerned about paying off of future growth of the business. Anything that's expected to grow over the next 9 to 12 months, 20%, 25%, buyers are very skeptical about that and not really willing to take that risk on themselves. So overall valuations are going to come down, and are going to be more focused on trailing numbers versus kind of projected or pro forma numbers.
David, tell me how are you seeing the sponsors sort of adapt to those new conditions, both as buyers and sellers?
We're seeing more private equity firms, wait on selling companies. They are waiting to see when the market kind of settles out, some of the uncertainty around the recession goes away. So they're being a little bit more patient in terms of exiting investments. On the buying side, what they're trying to do is, for those that can do more structured equity or minority investments, using that as an option for sellers. So instead of selling control of the business, maybe a better option is to sell a minority stake at a lower valuation, but the owner continues to control the business going forward and keep the bulk of the economics. Other ways they're trying to do it is around kind of the structure of the deal. So earnouts are becoming more commonplace now, or even royalty payments. So if the company does grow and it does what the sellers expect, they will receive something in the form of an earnout payment or royalty payments going forward.
So tell us, what is something that you like that very few other people like or appreciate out there?
Something I like, but I wouldn't say that other people don't like it or don't appreciate it. But people probably don't know that I spend a lot of time on it, which is a Peloton bike.